Right, thank you so much for putting all those details into perspective. But with this, it's time to touch base with our guest, Sushant Bhansali, CEO of Ambit Asset Management. Welcome, Sushant. I want to understand from you, as far as the markets are concerned, we are once again into the consolidation phase. If you talk about today's market, and that has been the scenario throughout the year. Yes, after GST announcement, it did look like that we will have some kind of momentum, but once again lackluster trade is back. What is your assessment of market for next 1 year or so?
Sure. Thanks for calling me on the show. Definitely, consolidation phase has been on. It's almost a year. And like the previous cycle, where between October 22 and till about, I think, June 23, from October 21 to June 23, almost 18 months of consolidation phase was there. Similarly, from last September, this phase has been going on. Market has been going up and down in a similar sort of range. And we expect it to be there for a few more months at least. And from a perspective about economy, if you look at the GDP numbers are showing quite good, but the inflation number is down. So overall, the nominal GDP increase is just probably still in single digit and not in double digit. And that's where I think corporate profitability is taking a toll. Last few quarters, we have seen profit growth coming down by every quarter. We are hoping and wishing that it has bottomed out in Q1. But looks like Q2 will be another low level of earnings. The GST benefits which got executed earlier this week, but were announced almost 1.5 months back. And I think we saw a lackluster sale between mid-August when the announcements were made, and between the festival season when it finally got executed. So that loss of sale and loss of, I would say, dealer hesitation to stock up inventory during that period would lead to, in many pockets, lower earning than expected for this quarter as well. Hopefully, if the festival season and the GST benefits revive the sentiment and the economic, I would say, macro, then Q3 onwards will look an uptick in the earnings. And from there on, I think which will be available as results by, I think, end January, early Feb. And from that moment onwards, I think we expect is when market might start rising and start taking new highs. Having said that, we have seen in the past the investors in this market don't wait too long. And for all you know, if the festival season sales are good and money is probably getting rewarded quickly than it has in the last few quarters, then that expected higher multiples and higher index levels might be there sooner as well.
Right. Sushant, hi, this is Ankita also joining in. Good afternoon to you. Sushant, so one thing is very clear that now one needs to be more domestically facing, the sectors that are more domestic facing now, especially with this GST rate rationalization. Of course, the focus has now moved to the consumption basket as well. What has been your portfolio rejig? What are you overweight on? What are you underweight on now?
Sure, no, definitely. I think one thing is quite clear that probably have focus on more domestic and less exports, especially I think exports related to US as a geography, because there's quite a bit of uncertainty going, things going up and down every week, probably every day. So stay away from because that volatility is not helping in these consolidation phase of the market. If market has a single direction, then you can still take those bets. But in this market, when only few companies are delivering, you cannot have that much of volatility in the portfolio. From our portfolio positioning perspective, definitely we have say stacked up higher on consumption side, be it automobiles, be it consumer discretionary, both lower end as well as top end. I think these are two things. In addition, I think we are now gradually building up positions in selective lenders to look at the consumer space. Unsecured lending, any which has been out of fashion for last few months and will continue to be under pressure. But these are the three pockets, I would say, both consumption led as well as the derivative of on the credit growth side related to consumer. So these are where we have been being overweight on our.
Right. You mentioned about unsecured lending as well as GST pickup, which is evident as far as data is concerned. We had just analyzed the data which came from Reserve Bank of India from 22nd and 23rd of September as far as payments are concerned. So yes, there is a surge in credit card spends in terms of value. UPI, RTGS, all these payments have seen surge from 21st September to 22nd and 23rd September. Therefore, I want to understand from you, is there a banking play which one can bet on for next 6 months to 1 year?
Yeah, I think retail-led banks will have a good time, as I was alluding towards the lenders, export NBFCs and retail portfolio banks. I think they will tend to stand and gain a lot. The corporate banking side probably will, I think, still take some more time. Although our belief is that from a long-term perspective, once the consumption cycle picks up and capacity utilizations hit about 80% plus, that's the time then private capital will start happening, and the corporate lending books will start yielding better results as well. From a perspective of, I would say, your data points on digital transactions, remember there is a base effect. Last year, the festival season was in October and not in September. So I'm not sure whether the data is on the Hindu sort of dates or probably the Roman calendar which we use, because the Roman calendar has the base effect for sure.
Right. So Shant, besides the fact that we are, in a time-wise correction, the other thing that's weighing down the market are the FIIs selling. Now, FIIs have turned in net sellers of Indian market. They are underweight on Indian markets, and comparatively, the Indian markets have been underperforming. So, perhaps the other positive trigger that we are waiting out for is a better earnings season. Should that happen, how do you see the markets move up then, and when do you see the FIIs make a comeback?
There is a good amount of interest, I would say, on India. Definitely, the weights in the portfolios have been lower in the last year or so. But I'm going on a roadshow to US and Canada starting next week. And the amount of, I would say, reception which we are getting has been just phenomenal. I have not seen such response in the last 3 odd years towards India. So definitely, there is a lot of, I would say, inquisitiveness on India as well as excitement, and that's why more and more people want to meet us. So I would use that as an analogy that when the right time comes, when the valuations are in favor, when all this mess on tariff etc. is behind us, is when probably the more global money will flow in. Interest rates have already started coming down with the first rate cut a few days back. From that perspective, in few months, I think FIs should start coming back to Indian markets and increase their rates. On the domestic side, I would say the flows continue to do well, and which is where I think the markets have been more, I would say, nuanced towards in the last 5 years as far as India is concerned. I think in the last 5 years, FI flows have not taken the markets either to make on the mix on the upside as well as on the downside. So it's more domestic flows. Any incremental FI cash flows into India in next few months, I think is where we believe that markets will ride further ahead, and 2026 will be that year.
All right, Sushant, thank you so much for joining at this hour with your views. With this, it's time to take a very quick break, but don't go away. We'll be